If you're thinking about buying a house in 2026, I have some sobering news for you. The math is getting worse, not better. Let me break down exactly who can actually afford a house right now and why the numbers are absolutely brutal. If you want to understand the real state of the housing market before you make any major financial decisions, you should subscribe to this channel. I'll walk you through the actual data. Let's start with the baseline. According to recent market data, the median home price in the United States is hovering around $437,000. Now, that doesn't sound quite as bad until you realize something critical. Median incomes have not kept pace. The median household income in America is around $74,000 per year. Try to do the math on that. You need to earn roughly 6 times your annual household income just to purchase a medium-priced home. That ratio used to be closer to 3 times. This shift happened in just a few years. But here's where it gets even worse. Mortgage interest rates have climbed significantly. Back in 2021, you could get a 30-year mortgage for around 2.9%. Today, rates are sitting somewhere between 6 and 7%, depending on your credit and down payment. That's more than double. If you're putting down 20% on that $430,000 home, you're financing $344,000. At 7% interest over 30 years, your monthly payment is around $2,300. That doesn't include property taxes, homeowners insurance, or HOA fees. Those could easily add another $800 to $1,200 monthly. So you're looking at roughly $3,000 per month or more. Financial experts generally recommend that your housing costs shouldn't exceed 28% of your gross monthly income. That means you'd need to earn around $129,000 per year just to comfortably afford that median-priced home. The median household income is $74,000. There's a $55,000 gap. That gap is real, it's growing, and it applies to millions of Americans. Let's talk about down payments. To qualify for that mortgage with decent terms, most lenders want to see at least 10 to 20% down. On a $430,000 home, that's $43,000 to $86,000. The median savings account balance for Americans under 35 is barely $6,000. Saving that down payment would take the average young person over a decade if they didn't spend any money on living expenses. That's mathematically impossible. Many people are turning to gifts from family, taking on additional debt, or simply giving up on homeownership entirely. Like this video if you appreciate understanding these uncomfortable truths about the economy. Then there's the credit score requirement. To get approved for a mortgage at favorable rates, most banks want to see a credit score above 620. That means you need an established credit history, which means you've been taking on and managing debt successfully for years. If you're already struggling to pay rent and build savings, you probably don't have the credit profile that lenders want. You'd face higher interest rates, larger down payments, or outright rejection. In some parts of the country, housing is somewhat more affordable. Rural areas and smaller cities still have homes in the $150,000 to $250,000 range. But here's the problem. Those areas often have limited job opportunities with lower salaries. The jobs that pay well enough to afford homeownership are concentrated in major metropolitan areas where housing costs are astronomical. A software engineer in San Francisco might earn $200,000 annually, but face home prices around $1.5 to $2 million. Someone in a small Midwestern town might earn $60,000, but find a decent house for $180,000. The person in the Midwest actually has better odds. What about renters? If you're already spending 40% of your income on rent, you're not building savings for a down payment. You're trapped in a cycle. You're paying someone else's mortgage, while your own homeownership dreams get pushed further away each year. As rents climb faster than wages, this cycle gets tighter. The average rent for a one-bedroom apartment now exceeds $2,000 in major cities. That's nearly as much as someone would pay in actual mortgage payments on a modest home, except you're building zero equity. Let's talk about what's changed. 20 years ago, you could buy a house with 5% down and a fixed rate under 5%. Lenders had looser standards. Home prices were lower relative to incomes. Interest rates were lower. The window to build wealth through real estate was wide open. That window has slammed shut. Today's buyers are facing higher prices, higher rates, stricter lending requirements, and lower relative incomes. That's the perfect storm. What about first-time buyer programs? Some exist, but they're limited and competitive. Down payment assistance programs require you to meet income thresholds that are themselves unaffordable. First-time buyer loans with lower down payments often come with higher interest rates, which means you're paying a premium for the privilege of not having saved enough money. It's a system designed to favor those who already have capital. So who can actually afford a house in 2026? Honest answer: people who already own homes and have built equity. People with high incomes in fields like tech, medicine, or finance. People who inherited money or received large family gifts. People willing to move to areas with severe job limitations. And increasingly, investment firms with access to cheap capital who are buying up single-family homes to rent them out, further shrinking inventory and driving up prices. For everyone else, homeownership is becoming a distant dream. The average person working a normal job can no longer afford an average house in an average American city. That's not an exaggeration. That's the math. And the math doesn't care about your feelings or your work ethic. It's just math. The real question is whether this continues or whether something has to give. Either incomes need to rise dramatically, or home prices need to fall, or interest rates need to drop significantly. None of those things are happening right now. So if you're feeling anxious about housing, you're not paranoid. You're paying attention. Leave a comment below with your honest take. Are you planning to buy a home in the next few years, or has the market pushed you toward a different life plan entirely? I'd genuinely love to know what you're thinking. And if you found this breakdown valuable, please subscribe to the channel for more real talk about the economy and personal finance.